Hey, good afternoon, everybody. Welcome to our short verticals webcast. I'm Connie Hill. This is the time we get together and talk about this bread and butter strategy that some of you might be using. How many of you are trading my example trades in your paper money account to just kind of track them? Well, how good did our trades do last week? Do you have any idea? Well, we're going to go into some detail about that. But if you are trading them in your paper account, go ahead and let me know that. And if you are, that should actually spur some questions that might come up for you. Now, I am joined in the chat by John McNichol. I'm happy John's here, great veteran of the market. He's here to help answer questions that maybe I can't quite get to. So if you have something, I'll keep an eye on the chat, but John will also have my back in case there's something I can't quite get to. Now, I hope you're following us on X. I'm Connie Hill CS. John is John McNichol CS. We'll post educational content throughout the week. We'll see things going on in the market that we may post about that you might find useful. So it's free and easy. Go ahead and follow us. Let's go through our disclosures and I will lay out our agenda. Options carry a high level of risk and are not suitable for all investors. What we discuss is for information and education. It's not considered a recommendation of any sort. We'll be using the paper money software application. This is what you download to your computer system. It is, I think, helpful as you're practicing strategies. You know, in the case of short verticals, as you're practicing them out in your paper account, it can really help you. Investing involves risk, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An in-the-money option has a higher risk of being assigned early. One thing you need to know is that paper money doesn't assign early. And so I don't want to have any idea there that can't happen just because it doesn't do it in your paper account, because it certainly can. It does happen. Past performance of any security or strategy does not guarantee future results or success. All right. 3 big events coming up, you guys. I hope you guys on the East Coast are able to capitalize on one of these events. All right, we've got Miami, June 13th. That'll be a Market Drive Saturday event. We'll have another one 2 weeks later in New York. That'll be the 28th. And then workshop for technical analysis and options trading, August 8th and 9th in New York. So if you're planning to go, great. We'll love to see you there. All right. We're going to talk about short verticals here and just kind of a concept or two before we get into some of our strategy here. I am hoping that all of you have been through the Getting Started with Options webcasts. That maybe you've already been working on short put verticals, because this is an intermediate level class, but I would like everybody to follow along, even if you're fairly new to the strategy. So we will be focusing on short put verticals here. We'll look at the market in a minute. But I want you to know that when you do a short put vertical, you have 2 contracts you're working with. One you're going to sell, the other one you're going to buy, and the net of those 2 contracts creates a credit that goes into your account immediately. Okay? You might go, oh, well, that's a little different than some of the other strategies, or when you buy a stock, man, you don't get anything till you sell it, right? And so that is something that's a little bit different about short verticals that can be appealing to some people. It typically is something that is bullish, although if the stock's a little bit neutral, that's okay. It can still work out, all right? What are some benefits and risks? Because there are always both sides in any kind of strategy. People typically do the short put verticals to create income in their portfolio because it's generating that credit when they put the trade on. Typically, it gives a lower break-even point in that kind of a trade. And then gains are limited to the net credit, meaning whatever you sell it for here initially, that's going to be your max gain, and you're pretty good with that, right? And then as far as the time frame that we'd be looking at here, really they're shorter to intermediate term trades, meaning we're not putting it on for 6 months or even maybe 4 months or 3 months, okay? We're using much shorter time frames. The max risk is the difference between your two strike prices less the credit that you received. Okay, that generally puts you in a position where you're going to be risking a lot to make a little. But the reason somebody might be interested in doing that is because of the probability of success, but that probability is higher if they structure it that way. Now, you don't have to structure it that way, but we typically are going to do that in this class. Now, I wanted to see here real quickly if anybody responded here about that they're following along with some of these example trades out in their paper money account. If you are, go ahead and let me know. I'd be curious to know that. All right, let's go out and take a look at what's going on in the markets. We've got our SPX up, and I would hope that you're looking at this every day, maybe more than once a day. Looks like the market's a little bit down at the moment. Okay, not a ton, but the SPX is down, what, 0.17%, so less than 1% here. Okay, but what has the trend been? Well, this red line is a 30-period moving average, and it's been heading up. This blue line is a 10-period moving average. It's been heading up as well, but kind of starting to go a little bit sideways here. That's fine. When we see this on the indices, then we have a tendency to see them a lot in stocks. Now we're going to pull up the NDX as well, because our watch list comes from the S&P 100 and the NASDAQ 100. Okay. Same thing here. You know, I would say the trend is kind of continuing a little bit more here with the NASDAQ than what we were seeing on the S&P, because we can see, oh yeah, here's a little bit higher high. So the pattern of higher highs and higher lows is still going on with a higher high today, although it looks like it's starting to pull back here a little bit as well, only down 0.2%. Well, what would we expect to see on the volatility index? The markets are down a little bit. Where do you think the VIX is? Well, let's get it in there correctly. The VIX is still down in some lower areas, and it's showing that it is, actually up a tiny bit, 0.03 or 0.17%, so super low. Okay, just a little bit of movement, really not that much change, but I would just kind of say generally it's down in a lower range where we're seeing less volatility, less, probably less concern, because the market still seems to be grinding up despite some of the things that we're seeing out there. News especially moves those stocks, doesn't it? Those indexes. All right, so some of you are trading these. Priya says, I just started recording recording your paper trades in the trading journal. Perfect. I'm happy to hear that. You know, that's one way you can gauge if you're making progress in a strategy, is if you keep track of the results. And then you can see, oh, this strategy, maybe I'm figuring it out because I'm doing good here. Or maybe you're not doing good and you're like, man, I need to work on this particular strategy. But if you kind of put it in there and forget about it, it's hard to really learn a lot of lessons from that. Kelly says, I'm just getting into the class this last few weeks. Great. Glad to see that. Chris is saying, you know, the market's we've got bullish momentum on the market, but it seems to be weakening a little bit. Yeah, I was kind of pointing out we're going a little bit sideways. Okay. So with that in mind, that kind of pushes us to focusing more on bullish put spreads as opposed to bearish call spreads. All right. Let's take a look here. Stock that we used last week, and we're going to use it again today. Okay. We're not reviewing our trades quite yet. We're going to do that towards the end. But because we're using the stock again, you're going to see some markings on my chart. Last week, we got in on this nice little breakout of the flag and continued to run. And the next day it went up and we got out of the trade. We were in there for like half a day. What am I seeing right now? I'm seeing that the price dropped back in kind of this flag area, and it looks to me like it's breaking out again. Now, it was higher earlier today. It's pulled back a little bit, but it still, for some traders, might look like a breakout type setup. So in our process, we typically will take a look at the markets and the VIX, see what's going on, form a posture, and then we will look at opportunities from our class watch list. Now, I had a couple technical issues last week, but we did end up getting our new watch list intact. And again, these stocks come from the NASDAQ 100 and the S&P 100. Okay, so Gilead is on that list, and all the stocks that we're going to do some example trades on today, all of them are going to come from this list. All right, let's see here. On Gilead, we don't see any earnings dates coming up, and that's one of the things you want to pay attention to, right? If there are any events coming on that you might need to know about, so pay attention to earnings dates, go out, check the news, make sure you know if there's like an FDA approval that they're saying, hey, the FDA has said on X day, they're going to let us know what happened in our phase 1, 2, or 3 trial, whatever happens to be, so that you're on top of those things that really could move your stock. Okay, let's go look at the trade tab here. Now, 20 to 40 days worth of time is kind of typical of what traders might look for, but sometimes it goes a little bit longer than that window. Sometimes it gets a little smaller than that window. In fact, earlier this week, we did a couple of trades that were a little bit less than 20 days. I think they were like 18 days till they expired. And so kind of fell out of that general window that we look for. On this one, however, we are going to use the July 18 options when that's going to expire. You can see here I've got July 3rd open, and here's my open interest column here. We're actually going to be working on the put side of things, and there's just not a lot of activity here. So when you don't see it, don't worry about it. Just maybe the weeklies just don't have enough volume in there, and that's okay. And we'll just work with the monthlies. They've been around longer. Typically, they're going to have a lot more open interest, okay? And so we can look out here and go, oh yeah, look at that nice open interest out there. Yeah, we could trade almost any of these contracts and not really be worried about it. Let's do this. Deltas can help us identify which one we want to sell. I told you we're going to sell one, we're going to buy one and create a credit, right? So on this first one, it kind of looks like maybe, a 20-something delta, sometimes a 30-something delta. Sometimes people will go into a 45 delta, but we're going to use this one that's kind of right in a sweet spot here, a 32 delta. And right now, it has a 63+% chance of expiring out of the money. Is that good for this kind of trade? Absolutely is good for this kind of trade, right? We want it to expire out of the money. And typically 60 or higher is when traders will say, oh, yeah, that gets us into a higher probability range, which makes it seem worthwhile if you've got a high probability of that trade. So let's go ahead and let's do a 105-100. We're just going to say sell vertical here. And the credits here, oh, this is even a little bit better than when I looked at it earlier today. So it looks like, let's lock in $1.30 so it's not dancing around on us too much, okay? So to figure out what our max loss is, we have to go the difference in the strike prices, which is $5, minus our credit that we bring in, because this is our max theoretical gain. Keeping those legs together, we won't earn any more than $130 per contract series that we do, okay? How much then is our max theoretical loss? Well, it should be $5 minus 130. That should give us what, 370? As far as our, I'm going to clean out these numbers here. We'll put in some new numbers here. So we'll have 130. Actually, let's see. It's actually 270, right? I said 370 initially, but let me do my math. We'll use the calculator just to be sure. So, $5 minus 130. Okay, it really is the first number I had, the 3.7 here. Okay, so we're willing to risk 370 to make 130. Now, when we're doing swing trades, We don't usually approach it that way, right? We try to risk less than what we have to gain. And so if you're like, well, why would I do that? Why would I risk 370 to make 130? And the idea is because you have a high probability trade going on here. It's really helpful if you do have a good bullish entry, or like this one where it's breaking out of where this area was for the flag. If it's breaking out, or if it's giving you a bounce, or sometimes we'll get other breakouts above resistance, you know, looking for a good bullish entry can always be really helpful to you. Okay, if we figure out what our return on this would be, that's going to be our next step, right? So let's go $1.30 divided by 370. It's going to give us about 35%. And so if you're a person that you're like, 35%, I'm good with that. That falls in the range of things I'm interested in. Great. If you like something a little lower and a higher probability, that's fine, right? You'd choose something a little further out of the money. Make sure it gives you a good enough return for what you're looking for. Okay. We're going to go ahead and do this. Now, we can risk in this account $1,500. So we're going to, okay? We're going to put our $1,500. We're going to divide that by 370 because that's our max theoretical loss. We can do 4 contracts. So we're going to put them on. 3, 4. Now, Andy just put a note in here about it's a 1% a day. It's a little bit under that, actually. Some people might have a rule, Andy, that they want at least 1% a day for however many days are left on the contract. In which case, for this particular trade, if that's a rule somebody's using, they'd want to get 43%. Now, we're only going to get 35. However, we're going to have a discussion later when we look at the results from our trades from last week. We're going to have a discussion about if what we ended up having was worth it. Okay? That may help you with that rule as you refine it for yourself. Okay, so we're going to change this to a first trigger sequential. Let's create our opposite order here. And you guys know one thing we've been doing is we've been saying if we get a chunk of that credit, we're out. We're not sticking around to bleed every last penny out of it. Okay? That's what I do with my toothpaste, but it's not necessarily what some traders want to do with spreads. They're like, if I've got a chunk, let's take it and run. Put on a new trade. Okay, what would be left here if we said, let's go with 75%. We get 75%, then 25% is left. So we'll multiply this by 0.25. 0.25. And that would be 32 cents. Okay, so we're going to go buy this back at 32 cents, and we would be happy campers if that occurred. Okay, we're going to make this good till canceled. We're going to confirm and send. We want to send it to our bullish short verticals bucket. All right. Question here, Larry says, is the max ROR you're willing to take on, or what is the max ROR you're willing to take on a short put vertical? You know, that may be different for everybody. Okay. We talked here about there being 43 days left, and so some people might want to get 43%. If so, they're probably going to have to be a little bit more aggressive. Okay, more aggressive might mean in order to get that, maybe selling the 110 strike. And if you look at the chart here, 110, let's go put where 110 is. I'm going to put my mouse there. Okay, so 110 is about there. Okay, there's our 110. And right now the stock's at 110.74, so it only would give you about 74 cents of leeway as far as where you would want the stock to stay above. Versus if we drop down to 105, okay, so about there's 105 and some change. You know, then that gives us $5 more leeway, right? So in this case, the stock, it could go kind of up like we think maybe it would do because it just broke out. We could also say it could go flat. We're getting in right now. It could go flat. Still would still feel like we're in a safer zone because I'm just going to draw 105-ish there. It could even come down a little bit. In fact, one of the examples we're going to look at, stock went below our short strike price and then came back up. Okay, and so it could still work out for you just fine. So you get to make that distinction, Larry. You get to decide for yourself what you're comfortable with, which is why it's so helpful. If you'll follow along with some of these practice example trades so that you can see, okay, what did we end up with? And we're going to run some numbers here today too. All right, next up, got another stock. Our watch list, it's Datadog. All right, what's going on with Datadog? Oops, that's not the one I wanted. I want to choose this one. Let's go out let's just go out, say like to a 9-month chart. Let's back out here a little bit. So it had been downward trending for a bit, bottomed out just like when a lot of stocks did, kind of had that V bottom and off it goes. And this 120-ish area is where it looks like it gapped up over today and it's staying up high. That looks like maybe it was old resistance. Right now, it's looking more like, hey, this should act as support. It's not guaranteed to act as support, but theory says, yeah, there's several touches on this line. It's pretty strong, so it should act as support. Okay, so some traders might take that. That's what we'd call a breakout. We still have a little bit of time left in the day, and so volume isn't above the average, but it could be towards the end of the day. Sometimes really high volume stocks, when they're breaking out, they may not have a ton of extra volume because they already have quite a bit of volume. For instance, maybe this looks like a cup and a handle. Yeah, very well could be. Yeah, in that little bit longer pattern there. Okay, let's go to the trade tab. Okay, so we are going through our examples. I'll show you where this is on the watch list. Right there is where it is on the watch list. This week it's up 3.9%. This is a 1-month calculation. It looks like it's up 15 point some odd percent in the last month. Okay, so it's making some decent moves. Implied volatility, I'm going to say, is barely high, but not super high right now. It's not going into an earnings, right? Earnings already took place back here. So probably have a couple months, maybe 6 weeks before they announce earnings again. So we're aware of when it is. Shouldn't be for a bit here. All right, next up, contracts. How many could we do and in what time frame? Again, I picked through some of these weeklies that kind of fit that window of 20 to 40 days worth of time. Not as liquid as what I like to see. Okay, I really like to see lots and lots of contracts there. I hope you are liking to see lots of contracts there as well. That gives us an idea of the liquidity. So let's go over here to our put side and let's kind of look at what deltas we have going on. We've got a 39 delta here for the 120 strike. We've got a 27 delta here at the 115 strike. Now, we'll pull up what I had in mind here initially, and we'll see if it looks like it still is going to work out. I had selected the 120, 115 spread. Let's see if this is going to give us enough of a return that we could be happy with it. All right, $5 wide spread. It's going to bring in a $1.70 credit. Now we just ran some numbers on one that was a $1.60 credit. I think it was in here, and it was 35%. Okay, so we know it's going to be over that. So that begs the question, well, could we go a little further out of the money? Could we maybe sell the 115 and buy the 110? Well, let's see if that one would give us enough. Okay, I'm going to lock that in at 113. Okay, if we have 5 minus 1.13, our max theoretical loss here is going to be 3.87. Okay, so we're going to go 1.13, 3.87. Now you're thinking maybe the math you might be doing in your head. And for some of you, you might go, this is great. And others of you are going to say, I don't know. Deep in the right spot. 113 divided by 3.87. It's a 29% return. Okay, that's close to 30 that a lot of traders might look for. What's the probability on this trade? Probability on this trade is about 68%. So we go a little bit further out of the money. We have a higher probability of success, but we also are going to bring in less of a credit. Okay, so that may meet some people's rules, may not meet other people's rules. Okay, if you were to look at this one and you're like, oh, the sell in the 120 is only a 56%. I don't, and if your rules are, yeah, you'd like to see it above 60 or higher to be higher probability, then you could do one or two things. You could take the 115, or you could say, I'm not comfortable with any strike price here. You can always walk away. In fact, I ran some numbers for several that gave us an entry point, but just didn't really have the right strike prices for us to use. Because this is pulled down a little bit, we are going to go with the one with a little bit lower credit. Okay, so we're going to go with the 113. We're going to say it's good enough for what we want. And if we're going to risk 387, how many contracts can we do? What's the first step? We're going to put in our 1,500, what we're willing to lose in any trade, divide that by our 387, which would be our max theoretical loss for one contract. Can't quite do 4, but we can do 3 contracts here. Okay, so let's go ahead and put on our 3, and we'll change that to a first trigger sequential. We'll calculate an opposite order here. Today, let's use the same number for each of the trades. Let's use, if we get 75% of it and we can buy it back for, say, the 25%, that would be happy to move on from it. Okay, so $1.13 times 0.25, we're going to go buy this back at 28 cents. Now I'm going to ask you a question here. If the trade would do it for us, we never know, right? We try looking at good entry signals, but we never know what the stock's going to do, especially after we get in, right? If this would give us that kind of a return by buying it back at 28 cents, would it be worth it to you if it could do this by next Wednesday? Okay, that would give us a full week in the trade. I'm curious to know what you would say in that circumstance. Let's go ahead, let's send this in. Let's put it in our short verticals bucket for the bullish side and send that on its way. Now, as I look in the chat, it looks like we have a survey. And you guys know from time to time, they'll put out a survey here. We don't control it. It's always random, okay? And so we love to get your feedback. We love to hear your comments. It's a super easy survey. You have 2 questions. You can fill in the radio button on a scale of 1 to 10. Pop, pop, you're done. There are 2 questions if you would like to answer. I encourage you to use that as space to either answer the question or communicate something different to me, because that's a great way that you can communicate. If you're having a problem with something, if you're wondering about something, go ahead and ask it, because I like to introduce those and teach from those comments when we have our classes. Okay. Getting a little feedback here as far as would it be worth it to you, I said. John says, I think a week is fine. You wouldn't mind that kind of a return in a week. Lisa says, I would normally close it out, but I am asking for understanding purposes. Oh, you had a question up here, Lisa. Let me find it. Should close out yourself before expiration? I think that's actually not your question. I think I finally found it here, Lisa. Want to make sure that I understand this. If a short put vertical expires below the bottom put, will the broker assign me the shares at the short and then sell them at the long? You're basically saying, is this going to be taken care of, right? Is the broker going to help me out here? So this is the deal. And we talked this kind of in depth in our Tuesday class of option strategies, selecting an option strategy, because that's a question that's come up in that class. And so we talked about it. We talked about ideally, like we'll use this trade as an example. Ideally, we want it to be above 115. And then the 110 is going to be our hedge leg here. So let's come over here and look at 115. So 115 is about here. So we've got quite a bit of leeway, $8 plus leeway before it gets down here to 115. So, if it doodles along up here, great. But you're saying, hey, what if it goes back down? Now, if it goes back down below both strike prices, then you'll be assigned the shares and they will go ahead and, well, you would get signed on it. Okay. The big question comes in is what happens if it expires in between the two contracts? Ooh, so I've got a potential obligation and it's not down as low as what my hedge leg is. So what happens? In that scenario, you very well could just be assigned the shares. Okay. I'm going to say most likely. Okay. Nothing is ever 100% absolute guaranteed. Okay. So you would most likely be assigned. And then the question comes up, what if I don't have money in my account to cover it? Okay. If you don't, what's going to happen? They're going to give you what they call a margin call. They're going to let you know, hey, you need to bring additional money in so that we can complete the assignment. Okay. So what can you do? One, you could put money in your account to cover it. Two, you could liquidate another position to free up some cash for it. Or you could, I was going to say, in that scenario, yeah, you kind of have to come up with the funds, and that sometimes means closing out something, okay, if you're going to margin call. I'm going to say it doesn't have to be an option trade that you liquidate to bring in enough funds, okay? It can be whatever you want in your account if you don't want to put money in for it, okay? I hope that answers the question. When it expires between the two strike prices, it's called pin risk. And I know some people are kind of jumpy about, oh, I don't know if I want to do short verticals because of that pin risk or potential assignment of shares. So one of the rules that we talk about here, our exit rules, are get out some time before options expiration. Some traders will start seriously winding down on some positions in the 5 to 10 days before options expiration. And there'll be some people who say, I am not going to be in it at X days before expiration. They just don't want to even take that chance. Okay. If you want to go back, and I'll show you where that class is that I taught, because that's exactly what we talked through in that class. So hopefully, Lisa, that makes sense, that you understand that. Yeah, there could be a same-day substitution. I can't speak for all brokerages, so that's why I have to say, make sure you know how your broker that you're using chooses to handle it, because they're not all the same. Okay, yeah. All right. Andy says, yeah, you could sell the other leg of the contract and pay the difference. Yeah, you could do that as well. Absolutely. Okay. Next up, let me show you where that class is. Now, if you are a subscriber to the Trader Talks channel, it makes things easy to find here. Now, I'm going to come over here to videos. I was just on the home take. Oh, look, and it's front and center, right smack here. This is the class I taught Tuesday. Are you afraid of a short vertical assignment? All right. Yeah, so we just barely did that on Tuesday. Okay. Yeah, if you're interested about that, then go ahead and go look at that webcast. If you, I'm going to show you a couple things. This is pretty new. I may have showed it to you last week. I'm not sure if I showed it in this class or not. We have something called a post. And on the post, we have here the weekly normal webcast schedule. Okay, so you can see day to day, who's going to teach it, what the time is, what the topic is. Not so much the topic, but the topic for the class. Okay, like short verticals, trading short verticals. And then you can kind of map out your week. Now, sometimes we do substitute for each other, and that's always the case, right? But these are who will generally be teaching that particular webcast. So that's a nice thing. I'm also going to show you some shorts. Shorts are just some videos that we've been doing. on different topics that are, and when I say they're short, they're like really short, okay? Like less than a couple of minutes or about a couple of minutes, okay? And there's even a video that somebody did to go along with that graphic in the post that I showed you, okay, about how to use that menu to find your webcasts. All right. Next up, let's do this. Oh, I'm going to show you one other thing real quickly here while we're on this page. And that is, I've started doing some really short videos on Thinkorswim, okay, that are super short in nature, okay, like 2 minutes or less. Well, actually, that's not true. One of them was about 6 minutes, okay, but they are fairly short, teaching you, if you're somebody that's new to Thinkorswim, some aspect so you can ramp up on your Thinkorswim learning, okay? So I want to point that out to you as well. All right, next up. I come back here and I want to talk through some of our trades. If we get through that, then there's another trade I want to put on. Okay, but I want to have some discussion here first. Now, I told you at the beginning, asking how many of you are following doing some of these example trades in your own paper money account. Okay, if you do, I think it helps you follow what's going on a lot easier is if you're new to the strategy. Right? And as you're trying to kind of figure things out. Now, I'm going to pull up here. We did 3 trades last week. And I put a note out in my X and I said, how did our trades do last week? Did they do good? Did they do very good? How did they do? Well, let's take a look. Boeing was our first trade. All of these were short put verticals. And on Boeing, we'll just zoom in on the chart here. We got in here on Thursday. There was Friday. There was Monday. And it got us out on Tuesday. Okay, so quick trade turnaround time. And here on Boeing, what we see is we got a 76 credit. And we said, hey, if we can buy it back for 21 cents, let's do it. Well, we even got a little better than that. We even got a little bit better fill initially, and we were able to buy it back for 18 cents. Okay, so that was, 3.5, 4 days there on that particular trade. Numbers wise, we were able to do 8 contracts there. So we made here a net of 58 cents. You multiply that by 8 contracts, that gives you a return of about $4.64, not including any of the commissions. Okay, have to subtract that, which rounded us out, even with the buying back, at about a 33% gain. If you divide 58 cents, which was what basically our net was here, and divide that by what our theoretical max loss was at the time that we got into the trade, which was $1.74, that gives us about a 33% return. So the question I want you to answer to yourself and here in the chat as well, was that trade worth it? Okay, was it worth the 33% return of $4.64 for about a 4-day trade? All right, let's see. Next one we traded was NEE. NextEra Energy. Again, we got it in our class time. We got in. We were able to get a 27-cent credit. This one is a single wide, which is really helpful in a smaller account if you're just trying to really not do big dollar trades. Okay, in our account, we could do 15 contracts here, so we did. We said we'd be happy to go buy it back at 8 cents, and it went and filled us at 6 cents. Okay, so the net on this is 21. So if we take 21 bucks, basically, times 15 contracts, that works out to about $315 on that particular one. And how long were we in the trade? Well, we had to get out 6/2, which was Monday. So on me, we got in, we had Friday, we had Monday, and we were out. Okay, so was that amount worth it? You get to decide for yourself, right? It says Fridays are making you nervous. Sharon says, where can I find that bullish and bearish watch list scan class? If I have a moment, Sharon, at the end, I'll show you. Okay. Because it is sitting out actually in that section about Thinkorswim. Okay. That I kind of pointed you to, but it wasn't showing those videos. Okay. Last one that we did last week, we've talked about a little bit because we are reusing it. We're doing another trade on it. Gilead, we got in on Thursday. We got 27 cents. We said we'd be happy campers if we can get out at 8 cents. And so it did. It got us out at 8 cents. We were in there for, I don't know, from the time of our class last week to the next day, Friday morning, 7:32, right when the market opened. Okay. On that trade, we had about a 26% return after we adjusted it for our net on this trade, right? Because that was 19 cents. We had 20 contracts, so that gave us $380. And I'm going to give it a half a day, okay? Because the market's going to close here in about an hour and some minutes, or you could just say 2 days, right? You're in the trade for 2 calendar days. All right. What do you think? What were these trades worth it? You could answer, well, maybe if you would like that, and you're like, I'd be satisfied with that. We're talking about the return and if it's worth it. On our second trade that we did here today, Datadog, the credit was a little bit lower, but the probability was higher. And so I asked you the question, if you could be out of that trade by next Wednesday, would it be worth it to you? And you can see from some of these examples that we did here today, we got out really quick. Now, does that always happen? No, that's never the case, right? Because we still have some trades out here that are a little bit older than last week's trade. Okay, Abbott's a little bit older, Google's a little bit older. I think Goldman Sachs was last week, and it might have been after, no, that was actually 2 weeks ago, Goldman Sachs, okay? So it's working. We're going to be patient. We're going to let it work. The ones that we still have remaining on here really aren't in a dangerous position. So we're just going to exercise patience. These are trades of patience. Sometimes we don't have to exercise it as long. That's not always the case, even though that's what happened on our 3 trades from last week. Okay. Chris said it's worth it when you're not sure about when you lose. Okay, that is one thing you have to keep in mind. When on a short vertical, if you take a max loss, and so we try to avoid taking a max loss if at all possible, right? It could wipe out several gains, right? Say on this last trade, we had 387 at risk. And if we took a max loss of 387, that could wipe out the profits of a few trades. So we try to not have that scenario happen to us if it's at all possible. All right, so good questions here. Very good. Appreciate your feedback here. Sharon, I don't have time to go show you where that video is, but I'll tell you, just go out to where I showed you those getting started with Thinkorswim videos. And I've got about 4, 5, 6 in there. And I've got the bearish one and the bullish one that you can go look up those scans. Okay. Very good. Well, you guys have been great today. John, thank you for helping me out with questions. Raymond says, is there any thought on slippage and commission when you have summary contracts? I'm not sure what you mean by summary contracts, but commission should always be a consideration. They're 65 cents per contract, which is, pretty low. But say if you're somebody that does 20 contracts every time, then you might consider spreading it out a little bit wider. But you don't have to, because that also increases your risk. All right. Well, you guys have a great day. Now, coming up next, I believe it's going to be getting started with stock investing. It's going to be the last time we're having it on this day, because next week it's moving to Monday time slot. But Kevin will bring you up to date on that. Okay, you guys, we're going to track these trades we put on. We're going to follow up with them next week. Make sure you've subscribed. Please fill out the survey, right? We always love it when you fill it out. If you submit something, I will read it, and our managers read it as well. We really appreciate that feedback you give us. And if this was helpful to you today, go ahead and hit the like button on your way out. John has just reposted that survey. Thank you, John. All right, we'll see you guys at the top of the hour with getting started with stock investing.